In 48 hours, a market that prides itself on instant liquidity revealed a weakness that doesn't show up on a price chart. Not a rumor, not a meme, a measurable bottleneck. Gold and silver were available on screens, yet the real-world line to withdraw bars stretched from a few days to 4 to 8 weeks. At the same time, 393 metric tons of gold moved into New York's exchange vault system, pushing inventories toward 926 tons, one of the largest inventory surges seen since the post-pandemic volatility cycles. They said this could never happen in modern markets. They said deep liquidity makes old-style squeezes impossible. They said price discovery is too efficient, too global, too automated to break. But the moment a withdrawal queue turns into a multi-week wait, the market stops being a single market. It becomes two markets, the paper promise and the physical object. And that split is where price discovery goes to die. Here's where it gets interesting. The posted price still looks clean. It always does, right up until it doesn't. The posted price is the most visible number, but it is not the most important number. The most important numbers are the ones that measure stress, delivery times, premiums, warehouse flows, margin changes, contract roll pressure, and the tiny spreads that suddenly widen when arbitrage can't keep up. It collapses when resonance hits, when the structure's weak point meets the right frequency. Markets are the same. They don't break because volatility is high. They break when the settlement plumbing meets a demand it cannot satisfy quickly, and the rules change to keep the system moving. Welcome to the data ledger, where we decode what matters before it becomes the headline everyone pretends they saw coming. If you like analysis that follows filings, flows, and incentives instead of narratives, you're in the right place. If this kind of breakdown helps connect dots you don't usually see connected, consider staying close. And as you listen, drop a comment with where you're watching from, because this story looks different depending on which side of the physical supply chain you live on. And now let's rewind and lay out what actually happened, with the kind of detail that makes the mystery impossible to ignore. Start with the core contradiction. Reports of a 4 to 8 week withdrawal timeline at the Bank of England weren't about price. They were about time. Time is the one variable paper cannot print. If you can't get the bar when you need it, then the hedge is not a hedge. It's a hope. Then look at New York. After the US election in November 2024, COMEX vault inventories surged. Roughly 393 tons of gold flowed in, taking the total near 926 tons. That jump isn't a rounding error. It's the kind of movement that requires planning, logistics, and a reason. You ship it because you need it where settlement happens, where contracts are written, where delivery notices can be satisfied, and where collateral can be pledged without paying up for funding and balance sheet capacity. And notice what happened to the incentive signal. When metal is scarce in one place and needed in another, the market has to bribe reality. At one point, the premium that made it attractive to move metal from London to New York was reported near $60 an ounce, then later compressed toward $10. That compression doesn't mean the stress vanished. It means the system paid the toll long enough to get metal moving, and once the flow established, the toll could fall. Now fold in silver, because silver is where the paper versus physical tension becomes louder. Gold is the reserve asset, silver is the industrial hinge. Silver has smaller inventories relative to daily flows, higher volatility, and a history of being managed through margins and rule changes when the crowd leans too hard in one direction. In early January 2026, another mechanical force showed up. Index rebalancing. A major commodity benchmark had a scheduled rebalance window that could translate into billions of dollars of futures selling on the order of about 13,000 COMEX silver lots, roughly 9% of open interest. That's not a prophecy, that's math. When passive money has to move, it moves whether the market is ready or not. A lot of it isn't making a discretionary call, it's obeying a mandate. If the index says reduce weight, the fund reduces weight. If the risk model says volatility is up, the margin goes up. If the prime broker says funding is tighter, leverage comes down. These are not opinions, these are procedures. And procedures become destiny when liquidity is thin. Put these pieces together and you get a market with 3 simultaneous pressures. First, physical withdrawal friction in a core vaulting hub. Second, a rapid relocation of metal into the exchange delivery system in New York. Third, a time-boxed wave of forced futures flows in silver. If you've studied market accidents, you know this is exactly how the tension builds. Not through one big headline, but through several small mechanics aligning at the same time. The central mystery is simple to state and hard to ignore. If the paper price represents the reality of supply and demand, why does the physical world sometimes refuse to cooperate on schedule? Why do premiums appear, queues lengthen, and metal relocate, even when screens tell you everything is fine? To answer that, you have to recognize that price discovery isn't just a number, it's a process. And the process depends on trust. Trust that contracts can be delivered, trust that arbitrage can close gaps, trust that rules won't change midstream, and trust that inventory numbers represent Usable inventory, not metal that exists, but can't move quickly. When that trust wobbles, you start seeing patterns. And this is not the first time. In 1968, the London gold pool collapsed. That was a coordinated system designed to stabilize gold's price through official selling. The moment physical demand overwhelmed the ability to supply at the fixed price, the structure broke. Result? The market split into official and free market pricing, and the old reference stopped functioning the way it had. In 1980, silver taught the world how leverage meets limits. A concentrated speculative push collided with rising margin requirements and emergency rule changes. Result? A vertical move, followed by forced liquidation, followed by years of mistrust from anyone who learned the hard way that rules can change when stability is threatened. In 2008, the world learned a different lesson. Paper claims can be plentiful, even when real liquidity is not. Credit markets froze and instruments that were as good as cash became illiquid. Result? Forced selling, emergency facilities, and a repricing of risk that happened faster than most people thought possible. In 2011, silver gave a cleaner demonstration of the same mechanism. As price accelerated, margins were raised repeatedly over a short period. Result, leveraged participants were forced to reduce exposure, and the paper price could fall faster than the underlying physical appetite, because the clearing system's first job is survival, not fairness. In March 2020, the stress arrived in metals with a modern twist. Transportation constraints, refinery bottlenecks, and sudden demand for specific bar sizes created dislocations between futures and spot references. The market responded not by admitting failure, but by adjusting contract rules and settlement pathways so trading could continue. Result? Spreads that surprised traders who believed a single global price could never fracture. In 1968, the issue was an official peg versus physical demand. In 1980 and 2011, it was leverage versus margin policy. In 2008, it was paper promises versus real liquidity. In 2020, it was futures references versus deliverable logistics. That's why the current signals matter. They aren't proof of collapse, they are proof of strain. And strain is where the next phase usually begins. Now let's talk about the players, because markets don't move on vibes. They move on incentives, mandates, and risk controls. On the infrastructure side, you have the exchange ecosystem. COMEX warehouses and vault operators, clearing members, and the futures exchange that sets the framework for what counts as deliverable and under what conditions. That framework is powerful because it can turn a chaotic scramble into an orderly queue, but it can also turn an orderly queue into a forced exit if margins rise or delivery becomes more expensive. Then you have the London side with its own gravity. It's a network of vaulting, clearing, and allocation practices built over decades. When withdrawal timelines lengthen at a central institution, it signals the network is prioritizing order over speed. That's rational from a stability standpoint. But it's also a signal that the easiest metal has already been claimed, and the remaining metal is either spoken for, harder to mobilize, or moving through a slower path. You also have the benchmark and passive flow side. When an index rebalances, it doesn't negotiate with the market. It is the market, temporarily. A forced wave of selling or buying can overwhelm a thin order book and create temporary dislocations that look like fundamentals changed overnight, even when they didn't. And finally, you have institutions that care about settlement above all. Banks, refiners, bullion dealers, and large asset managers. They don't need to believe a narrative. They need to manage basis risk, delivery risk, and funding risk. When they move metal, it's often because the cheapest hedge is no longer reliable under stress, or because a location constraint has become a risk factor all by itself. This is the part no one is discussing. Coordination can happen without conspiracy. If multiple institutions face the same risk model and the same settlement incentives, their actions will align. The timing will look coordinated because the risk controls are synchronized. A margin model says tighten, so everyone tightens. A withdrawal queue lengthens, so everyone who can pulls metal earlier. A roll window approaches, so everyone positions for the flow. Now, how does the dislocation actually show up? It starts with two prices that should be nearly the same, drifting apart. It can be New York versus London. It can be futures versus spot. It can be deliverable bars versus available bars. It can be the East's import premium versus the West's screen quote. The form changes, but the message is consistent. The market is paying extra for certainty. In the recent stress, the spread incentive reportedly widened enough that moving gold from London to New York was rewarded by a premium around $60 an ounce before compressing to roughly $10. That swing tells you the arbitrage mechanism was active, but it also tells you the mechanism needed a bigger than usual incentive to do its job. In a healthy system, small spreads pull metal. In a strained system, the spread has to scream. Then you look at the vault data and realize something subtle. The headline inventory number can be enormous, yet still not solve the problem. London vault holdings can be counted in thousands of tons of gold and tens of thousands of tons of silver. But holdings are not the same as float. Some metal is allocated, some is encumbered, some is committed to products, some is simply not positioned for immediate withdrawal. This is where the paper versus physical argument usually gets sloppy, so let's keep it precise. Paper is a claim structure. Futures are contracts. OTC forwards are agreements. Unallocated accounts are balance sheet exposures. These instruments can function perfectly well, as long as the system's conversion from claim to metal is credible when tested. The moment conversion becomes slow, expensive, or uncertain, the instruments don't vanish. They just stop being perfect substitutes for physical metal. That's why withdrawal timelines matter more than inventory headlines. Now bring silver back into focus. Silver has an additional complication. Industrial demand doesn't care about narrative. Manufacturers don't hedge because they love charts. They hedge because they need supply continuity. When industrial demand meets investment demand, the paper market tries to clear both with the same reference price. Volatility becomes the pressure valve. This is also where margin policy becomes the mechanism that turns paper into paper. When volatility rises, exchanges and clearing firms increase margin requirements to protect the system. That protection is rational. But it has a side effect. It forces leveraged participants to reduce exposure, regardless of their view. Forced selling can push the paper price down even as physical demand remains steady or rises. Two realities diverge. Think of it like a stadium with two exits. One exit is wide and well lit, the other is narrow and clogged. The announcement says, exit calmly. But if the narrow exit is where everyone actually needs to go, the crowd doesn't care what the announcement says. The crowd cares about throughput. Paper markets are the wide exit. Physical delivery is the narrow exit. Most of the time, the narrow exit never gets tested. Under stress, it does. When the narrow exit gets tested, price discovery changes character. The reference price becomes less about the marginal buyer and seller of metal, and more about the marginal buyer and seller of risk. There's another mechanism that matters here, because it's how large players keep the machine running when simple arbitrage doesn't. It's the ability to swap exposures across venues, to convert one form of claim into another without ever touching a bar. In futures markets, that can mean shifting exposure from a futures contract into an over-the-counter position, or using exchange for physical style transactions that settle a futures obligation through a different channel. That isn't inherently suspicious. It's a pressure release valve. The important point is what it implies. If a market needs routing workarounds to stay smooth, then the smoothness is engineered, not automatic. And once the system is routing around blockages, the posted price becomes less about the metal and more about the route. The market can stay orderly, while reality is messy, because order is maintained by rule books, not by abundance. And that brings us to the evidence, the stuff you can count. Evidence point 1 is the sheer relocation scale. 393 tons moved into New York's delivery ecosystem, lifting inventories toward 926 tons. That is a signal of preparation. You don't move that much to make a statement. You move it to make sure contracts can be satisfied, to reduce basis risk between venues, and to ensure that if delivery is demanded, the system can point to bars sitting inside its own walls. Evidence point 2 is the time signal, a withdrawal wait expanding to 4 to 8 weeks at a core institution. Time signals are rare because they're hard to fake. A price can be supported by liquidity. Time cannot. Evidence point 3 is the premium swing, roughly $60 an ounce of incentive compressing toward 10 after shipments increased. That is a stress thermometer. The premium widened because the market needed to pull metal urgently. The premium narrowed because the metal started moving. The existence of the premium is the point. Evidence point 4 is the forced flow math in silver, an estimated 13,000 futures lots connected to a rebalance, in a market where open interest and liquidity can be meaningfully impacted by a single scheduled wave. That creates a window where paper price can be pushed by mechanics rather than by new information. Evidence point 5 is the scale illusion in vault statistics. London can report gigantic aggregate holdings, and New York can show swelling exchange inventories, and both can be true while the available deliverable now quantity is much smaller. The market doesn't fail because the total is zero. It fails because the marginal bar is in the wrong place, the wrong form, or the wrong legal status when it's needed. Now, what does all of this mean if the pattern continues? Historically, when physical friction rises while paper mechanisms are used to keep trading orderly, the next phase is a credibility test, not a collapse, a test. The question becomes, can the system clear claims at the reference price without creating a bigger and bigger set of exceptions? There are a few ways that test resolves. In a conservative scenario, the system absorbs the strain. Metal continues relocating. Premiums compress. Withdrawal timelines normalize. Paper and physical reconverge, and the market forgets it was ever close to a fracture. This can happen if demand softens, if financing loosens, or if supply arrives faster than expected. In a moderate scenario, the system stays functional, but the seams show. Spreads remain wider than normal. Delivery becomes more expensive. Contract specifications and settlement pathways get adjusted again, not because of scandal, but because continuity is valued more than purity. The reference price still exists, but fewer participants treat it as the final truth without checking the physical indicators first. In a more aggressive scenario, a single event forces a sharper repricing. It could be a sudden surge in physical demand, a funding shock that tightens liquidity, or a wave of forced futures flows that collides with limited deliverable supply at exactly the wrong moment. In that case, the price doesn't revalue because a commentator declared it should. It reprices because the market has to pay to restore confidence in settlement, and because the cost of certainty rises faster than the cost of exposure. Notice the language. This isn't prediction. This is the historical shape of similar stress events. A credibility test resolves either by relief, by adjustment, or by repricing. So what do you watch if you want to understand whether price discovery is bending? Watch delivery-related spreads between venues. Watch physical premiums paid for immediate metal. Watch warehouse inflows and outflows, especially sudden surges into exchange systems. Watch margin changes during volatility, because those changes tell you when the clearing system is prioritizing protection over participation. Watch how quickly queues form at key vaulting hubs. And watch scheduled flow events like big index rolls and option expiries, because forced flows are where fragile structures reveal themselves. One more indicator sits in plain sight but rarely gets airtime: the composition of inventories. In exchange vault reporting, eligible metal can simply mean it meets specifications, not that it is committed to delivery. Registered metal is the category more directly tied to the delivery process. When stress rises, the ratio between these categories can matter more than the headline total, because it hints at how much metal is truly ready to satisfy a surge in delivery demand. Combine that with funding and tightness signals like higher lease rates, pockets of backwardation, and unusually large exchange for physical activity, and you can see the system choosing flexibility over purity while trying to keep references intact. Also watch language. When market plumbing is stressed, the language becomes careful. Those phrases are not lies, they're signals. They appear when someone has looked at the pipes and decided the public doesn't need the full schematic. This is the divide. Most people watch the posted price and assume it is the full story. Institutions watch the settlement conditions and treat the posted price as one input among many. That difference isn't about intelligence. It's about what each group is forced to care about. Institutions can't afford a hedge that fails under stress. They plan for stress by watching the plumbing: location, form, timing, financing, and rules. And the wealth gap often follows the information gap. The public learns the story after the repricing. The institutions see the stress building and adjust earlier, not because they are clairvoyant, but because their risk systems demand it, because their mandates punish surprise more than they reward bravado. The day physical breaks from paper, price discovery doesn't disappear in a dramatic explosion. It quietly migrates. It moves from the most visible number to the least visible constraints. It moves from charts to queues, from headlines to vault doors, from narratives to settlement rules. It moves from what's easy to share to what's hard to explain, which is why so few people notice it happening in real time. And that shift is already measurable. This is the data ledger, where we decode what matters before it's everywhere. If this connected dots you hadn't seen connected, you know what to do. And remember, the real question isn't whether markets can print a price. The question is whether that price can still deliver reality when reality shows up to collect.